Hello, new week. World economic news, let's start. This is from the Fed flow of funds put together by Global Macro Monitor, and it's a natty little chart. It's who's funding the US budget question mark. Annualized US dollars. Annualized meaning that these are in quarters along the bottom axis and they're multiplied by 4. If they need to get rid of 500 billion treasuries in the quarter, they annualize that by multiplying it by 4. So it'll go up to 2 trillion. Dig. Okay, let's start right over the far left, where things were not too bad. They were just before the chaos started. And you can see the blue, which is other domestic, that's rich people in the United States were actually selling treasuries to get in on the act of the madness that was going on. And buying the treasuries was in red, the rest of the world, a small amount of Japan and China and that sort of thing. And the Federal Reserve were buying 1 or 2, just general business going on. That would have been in POMOs, but it doesn't really matter. So we get to the end of 2007 and things are very normal. But then 2008 hits, and it's very strange that the Federal Reserve was actually selling treasuries into the market and taking in cash. In other words, taking cash out of the market, which was very strange in quarters 1 and 2 of 2008, and probably a mistake. But then we go into the quarter 3 and 4 of 2008, and we've got other domestic. This is other domestic I'm going to call the rich bastards. The rich 10%, 1%, all that lot were taking their money out of all sorts of things, going and buying treasuries, thinking I'll at least keep hold of my wonderful wealth. And the red, the rest of the world, China, well, the rest of the world. These are people that have got big balance of payments, positives. China, Japan, and the oil selling countries. They've got lots of spare cash, and they went in, labelled their flight to quality, and went into US treasuries, just like the rich bastards did. The rich bastard countries did as well. Moving along into 2009, in gold there, the Federal Reserve comes in again. Well, let's call it yellow, not gold. And that's QE1, and they did some treasury buying with QE1 to help the domestic and the foreigners buying treasuries. But don't forget, QE1 was mainly about buying mortgage-backed securities, $1.2 trillion worth, as I remember. And then between QE1 and QE2, the yellow Fed went out of the picture, and it was left to the rich bastard people and the rich bastard countries. But now, interestingly, Q3 of 2010 was mainly rich bastard countries, and now the rich bastard Americans have gone somewhere else. They're putting their money elsewhere now. Maybe they've gone back into equities or other things anyway, and now it's left QE2 to the Federal Reserve in yellow and the rich bastard countries, and they're the only people. 99.4% of treasuries sold, getting on for annualized $1.4 trillion worth is only now being sold to the Federal Reserve and the rest of the world. And don't forget, the rest of the world, you can consider sovereign wealth funds, treasuries, or central banks, government operated, manipulated, coming in and buying treasuries. Interesting. Moving on. ECRI, this is still in the States. It's meant to be the best of the leading indicators, the ECRI. Let's go along the bottom first. This might make a video a bit longer, but let's go along the bottom. When the blue line, the ECRI line, goes down, south of 0, it normally drags red lines down with it. Now, red lines are the opposite of the green, which is GDP going negative. And as you can see, first one goes down, and it makes it go negative. Second one does, third one does, fourth one does. The crash of 1987 was really only a stock market little zip down and zip back up again. That wasn't the real economy going down. The next was the 1991 recession, which was real, so GDP went down. Financial crisis again, 1998, not important, and it wasn't deep enough. Then the 2001 recession was real, ECRI was down and GDP was negative. Obviously in this great recession, ECRI well down and lots of negative GDP. Now this is the one that I was calling at the end of last year for quarters 3 and 4 of 2010, where ECRI was going well down and could have been and maybe should have been a double dip, but it never was for some reason. I'm still not sure quite why. Everything seemed to turn out so well at the end of last year, but it did, and ECRI has continued now going back up again. So we can think that at least quarter 1 of 2011 should be quite good, or at least not bad. But we've got to ask now what will happen to the ECRI now. Not just because I'm in a negative mood, I think it's going to start turning down again quite soon. What with all what's happening in the world and like. Yeah. Next, it's the chart that I drag out more than any other. It's the M ratio from the St. Louis Fed, and it's the amount of people employed compared to the amount of people in the population. Yeah, and you can see which way to look at this. I've drawn the yellow line in to show that it reached 58% in the 1950s, and it's just dancing above the 58% line now. And since 2000, it's just been on the down and down. And really, I can't see the economy really firing at all with the M ratio as low as it is, compared to where you can see in the 70s it was low down at 56, and it moved itself all the way up to the mid 60s, and that was lots of people working and lots of people turning over, and so lots of GDP. But at the moment down at 58, where it was in the 50s, surely the economy can't be firing properly. Anyway, this is from Haver Analytics, Gluskin Chef, David Rosenberg. Breakfast with Rosie, who is now going on a paid subscription, so we won't get so many of these charts. But these are just recently, 2008, 9, 10, and moving into 11, where we can see real average weekly earnings. And they went up at the end of 2008. They were looking as though it was going to go fine, because more earnings going in there, more people have spending money, and the economy moves on. But it's dropped down to lower levels since then, and you can see at the end of 2010 into 2011, earnings are going down again. And with earnings going down, that's what I think will push ECRI down, and sentiment figures will go down. It's not surprising with the price of gas and food and all that everything is on the turn down now, I think, again. Maybe, should be, could be. Right, Quake Response puts yen on the line, an article by Peter Schiff, who I must admit annoys me greatly. But there's something in this article that I really quite liked, and it's this bit that I've dragged out. Should I read all three? I'll move into all three because I think it's an important thing. And it's Monday, isn't it? We've got plenty of time. After all, absolute purchasing power. This is about Japan and the yen. And you know that all the G7 have come in to interfere with the level of the yen in the forex markets. And Schiff is questioning whether they're doing the right thing. After all, absolute purchasing power is far more important than nominal export earnings. We've got time, but I can't explain everything. But this is it's well written. This absolute purchasing power is far more important than nominal export earnings. If he doesn't explain it properly, I will. When the yen gains in strength, Japan earns more dollars, or spending power, from its exports, which could now be used to purchase the raw materials necessary to rebuild the infrastructure. Yeah. However, by weakening the yen, Japan earns fewer dollars for its exports, or earning purchasing power, increasing the economic burden of reconstruction. Strong yen means they can buy more kit to rebuild with. Conventional wisdom is that a weakening currency is a boon for economic growth and exports. However, history does not support this view. Now, this is an absolutely huge point, because there's an awful lot of this sort of thing going on in the world. Now, I'll just repeat that. Conventional wisdom is that a weakening currency is a boon, in other words, very good, for economic growth and exports. However, history does not support this view. Certainly not in the Japanese case that Peter Schiff quotes now. For example, during the 20-year period from 1971 to 1991, often referred to now as an economic miracle, the Japanese yen tripled in value against the dollar, an average appreciation rate of about 10% per year. Incredible. This increasing purchasing power enabled the Japanese to enjoy a steady economic growth and rising living standards. And a housing boom, but that's beside the point. Over that time, Japan's GDP grew at an average rate of 4.5%, and net exports increased fivefold. So a strong currency isn't necessarily bad for exports and everybody in the country. I mean, Switzerland comes to mind, does very well on a strong currency, and companies inside Nestle don't do badly on a strong currency. Anyway, I haven't got time to stay. Okay, let's go to China. This is a nice chart that shows monetary growth is slowing in China. Let's go right to the critical end, end of 2008. They realized that with the world economic slump on, that they would pump it up, pump it up, pump it up, and they did. But they've realized it's caused inflation, so they're trying to pour water on it and pump it out, pump it out, pump it out. And this is China, a shorter term overheating indicator. This is the industrial overheating indicator in those funny green bars up and down, and CPI inflation. You can see in early 2008 their inflation was getting out of control then, but the world slump came in and brought it down. And now CPI is starting to turn up again and could well fly away, but they've turned down the overheating indicator by turning the money supply down. But it's really driving a mad, crazy vehicle there. It's really difficult, and the steering wheel isn't completely connected to everything. So they're having trouble. But I think they'll be all right, because the whole world might turn down again. But if not, China does have terrible trouble with inflation. But they're really doing the right things to try and calm it down. But will they have a property slump to go with it, which won't do them any good at all? Oh, we've still got a bit to do. Okay, 3 states seek to kick habit of raising cigarette taxes, as some states look to tobacco tax increases to plug budget holes. A few are bucking the national trend and saying, "If you smoke 'em, we got 'em," looking at dropping the rate to boost cigarette sales. I put this in just to show that I think local governments and governments are really showing themselves too clearly now to be cynical bastards, cynical, hypocritical bastards. And this just shows it. They put these sin taxes on and have gone in the past saying how it's to save us from ourselves and all that sort of stuff. But it's obviously just hypocritical nonsense. And this shows it clearly. Dropping the rate to boost cigarette sales. When they have to, that's what they'll do. Oh, CalPERS expected to cut forecast of portfolio profit. I'll just read this. I think it's funny. But it's not funny for California, it's tragic. In a move that could intensify the debate over retirement costs, CalPERS is considering cutting its official forecast of investment profits by a quarter of a percentage point. And why only a quarter, we'll see here. While the change seems subtle, it has major implications for taxpayers and public employees. The less CalPERS assumes it will earn on investments, the more it's likely to demand from taxpayers, probably tens of millions of dollars more. In other words, if they don't make it, they tell the taxpayers to make up the difference. The California Public Employees Retirement System, CalPERS, already imposed $400 million rate hike on the state this year to help it recover from huge investment losses in 2008. Following months of study, CalPERS staff this week said the forecast should be shaved to 7.5% from 7.75%. That's what they're projecting that they're going to earn in the future. Only a mere 7.5%. Good bloody luck to them to get that, and good bloody luck to the taxpayers of California when they don't. Finish with the Bank of Japan, almost back to 2004 numbers. The Bank of Japan unleashed, let's do dollars, $345 billion of fresh liquidity. That's a lot of money, $345 billion. Throughout its emergency quantitative easing operations over the course of the past week, which means we're likely to be not far off the lots of money that the central bank was pumping into the market at the height of its QE program back in 2004 and 5. They're no strangers to this. BNP Paribas F4X team on the force of this week's move says, there is another wave of global liquidity in the making, this time coming out of Japan. This liquidity will not stay in Japan and will boost asset prices elsewhere. There will be similarities to the summer of 2010 when the US prepared for QE, boosting shares and other assets globally and weakening the US dollar. This time it will be the Japanese yen funding another rush into global assets. We would expect the commodity and pro-cyclical currencies to rebound in the current environment. And will this save CalPERS and California asset prices? Will more money go into US treasuries and save them? And is this just another scam by sovereign wealth funds, treasuries, central banks to keep asset prices up? It's a wicked world out there. It really is. Have a good week. Bye.